Hello there, welcome to Market Call. I'm Andrew Bell in today for Marella Fernandez. And our guest is David Driscoll, founder, president and CEO at Liberty International Investment Management. David will be taking your questions on global stocks. The toll-free number, 1-855-326-6266, or email us marketcall@bnnbloomberg.ca. David, thank you very much for joining us.
Hi, Andy. Long time no see.
Yes, it's ages since we spoke. Tell us, have there been, as Borat would say, learnings? Have there been many learnings this week for investors in terms, or the past 2 weeks, in terms of the volatility of the tech names?
Well, I think this is part of the lessons being taught right now, is that for the last 2 or 3 years, we've really had a momentum market. And now it's being tested now once we're out of Q3 earnings season as to what's going to happen next. And usually when you get a company that's a large market cap component of the S&P 500, chances are that they will tend to slide a little bit. Mm-hmm. So we've had a topsy-turvy year because in September, the market usually falls, but we rallied. And now we're into November when we normally rally, but we're starting to see a sell-off right now. And it is tax loss selling season as well. So there could be a lot of window dressing going on by portfolio managers of selling their losers and eventually getting in to buy the winners.
Now, you say that yesterday the S&P actually went below its 100-day moving average. Has it managed to get above that since?
Well, today the market's up about 0.5 to 1%. So it's holding steady right now.
Sure.
But it's almost like every news item that comes out these days is going to either push the market higher or push it lower. And right now, the focus is on the Federal Reserve and whether they're going to cut interest rates in December. So everybody's kind of sitting on the fence right now, just waiting.
And if the Fed, say, doesn't cut next month and comes out with a very hawkish commentary, presumably that will put a shadow over stocks.
Definitely, because that's what the expectation is for the momentum stocks or the growth stocks, is they need interest rates to continue to fall for them to see their profitability rise. So it's not just the tech stocks, it's also the small caps. The small cap stocks are more interesting right now because the Russell 2000 index hasn't really performed much this year. And that's because small businesses in the US are taking it on the chin because of the tariffs. Mm-hmm. If you're a small business and seeing a 40% tariff attached to all the things you have to import to create a final product, they have two choices. They can either increase prices and send the tariff off in a higher price to the customers for fear that the revenues are going to fall, or eat the tariff themselves, watch their free cash flow fall. And if they have to borrow money to grow, the banks may not lend to them. So that's the big reason why the Russell 2000 is doing so poorly this year.
David Driscoll is our guest on Market Call today, and he's taking your questions on global equities. The number to call, 1-855-326-6266. We'll be right back. We are back, and David Driscoll is taking your questions on global stocks today. We have an email from Ray. Ray is asking, what does the guest think of Thomson Reuters?
Well, Thomson showed a decent earnings print in the last quarter. The legal professional side was up 9% for organic growth, but they were suffering from the print side, the Globe and Mail investment. Its organic growth was down 4%. So they're seeing a slower print recovery, government contract cancellation, softer corporate sales momentum. And that's what drove the stock price down from its peak to where it is now. Moving forward, the business is solid. They're probably seeing a little bit of softness right now, but at these levels, you've almost seen a 15% decline just in the last little while. So for most investors, this is a decent time to be adding to this name.
Okay. Andre, one of our regulars calling from Chilliwack, BC. Go ahead, Andre.
Andrew, thank you for taking my call. I haven't called in a while because everybody's getting tired of me.
Oh,
but
never. Go ahead.
Oh, thank you. You're very kind, and you're always on TV. You do an excellent job. Please, can I get your thoughts on Google? Are you in the camp, Mr. Driscoll, of Ray Dalio of a potential bubble in AI, or are you at Jensen's side saying that there's lots of growth left? I'd like to hear your thoughts on that and what you think about Google and if you hold it. Thank you. Have a great weekend, both of you.
Thanks.
Okay, so the trend these days in these markets is really multiple. So at the very top of the trend, you've got AI and the hyperscalers, of which Google is part of. You can also throw in Amazon and Microsoft there too. So they're putting the boots to software companies because they're able to compute at a much faster level and take all of that business away from them. Google also is coming out or has produced a quantitative or a quantum computing chip, and Microsoft has produced something that keeps these chips cool while all of this computation is going along. So at the top of the grid, you want to have at least one of these hyperscalers in your portfolio, because if quantum computing does become reality in the next 5 to 10 years, then they're the ones that are going to be dominating the space. And quantum computing calculates millions of times faster than AI chips. So it's one that you want to have in your portfolio. If you're worried about a bubble bursting, then it's important to be disciplined. By the name, if it doubles in price, you need to take half off the table, and that protects your downside over time. But it's important probably that investors have one of the hyperscalers in their portfolio, simply because if the movement moving forward is towards quantum computing, and this is the new trend over the next 10 years, then you've got to have exposure to that space.
We have Dave calling from St. Catharines, Ontario. Go ahead, Dave, please.
Oh, Andy, thank you for taking my call.
Thanks.
David, I'd like to ask you about Royal Bank and where you see it in the next year, 2 years. How do you expect the banks to do well or continue to do well? I'll hang up and listen. Thank you very much. Bye-bye.
Well, the banks in general have had a great year so far because, again, the Bank of Canada has been cutting interest rates, and then they get the spread between loans and deposits, where the deposit rates aren't rising to a huge degree, but mortgage rates are starting to go higher. The one concern I have for the banks is if the mortgage renewals are coming due these days. Think of somebody who had a 5-year fixed mortgage at 1.5% in 2020 coming up for renewal this year or even next year, where they may be looking at 4% plus. And what's that going to do for the actual consumer? Well, if they have to use more of their take-home pay towards debt repayment instead of buying stuff, then that puts pressure downward on the economy from growing at the same time that risk begins to rise for the banks. So we've had a great year among the banks because of lower interest rates. I think it's going to be a little more challenging next year for the banks, especially if we start to see loan loss provisions begin to rise.
We have Susan sending us an email. Can I get your opinion on Bird Construction? Is this a buying opportunity?
Bird is a really tiny little company. Its market cap's only about $1 billion in size. And they're in the contracting business. It's been a tough year for Aecon and other contractors. So the flip side is, of course, if the government of Canada is going to start spending on infrastructure, then that bodes well for them. They beat expectations. So it's just a matter of trade issues holding back spending in the short term among businesses. But the government spending on infrastructure should help. They've got a $10 billion backlog. And given the weakness that we've seen so far in 2025, if you want to own a small cap like this is a nice little entry point for a long-term hold.
Okay, we're going to be back with David Driscoll. David is founder and president and CEO of Liberty International Investment Management, and he's taking your questions on global stocks. Sylvain in Montreal is on the line. Go ahead, please.
May I have your outlook for TELUS, please? Thank you.
Tell us.
Okay, so this is a little story that kind of goes into what may be going on with the tech stocks as well, with their capex spending. If you think of the telecoms, all of them, so this would be TELUS, Rogers, BCE, a lot of them were building out their 5G networks and borrowed a lot of money, between 20 and 40 billion, to be able to provide the 5G service, thinking that customers are going to pay up for this, when in fact they went to the El Cheapo of the Kudos and the Fidos of the world. This has really hurt the telecoms because there's the 3Ds of investing, which is debt doesn't disappear. Revenue growth has been flat. BCE had to cut their dividend. TELUS is now having to consider more asset sales because right now their free cash flow is not covering their dividend, in my opinion. And that's why the stock price is continuing to fall. If the asset sales go through, then they should have enough cash flow to continue to cover the dividend, as they just recently increased it. But it's a tough business to be in right now when your revenues aren't growing. They're trying to cut back on capex and do asset sales across the board, but it's still a sector that isn't really doing a whole lot right now. And then we carry that into the tech sector, where a lot of companies are spending hugely on trying to get access to equipment or data center building, which isn't cheap. And as a result, we'll see down the road whether all of this investment is going to have any kind of economic profitability. So that's the big question that's out there with the big tech names right now with AI, is you're spending hundreds of billions of dollars on the next step in the process. Are you going to get an economic return from it? In the Canadian telecom sector and even in the US, that hasn't happened with all of their build out. So they're all sitting there with 20 to 40 billion in debt and desperately trying to be able to compete on price to get their revenues back up. But with a drop in immigration, revenues aren't growing, and that's causing them to just kind of go sideways for the past few years. And I would imagine it's going to continue that way in the future.
Okay, so you're not attracted by the telcos right now. Keith in Paris, Ontario, far ahead, please.
Mr. Driscoll, I was wondering if I could get your thoughts on Enghouse. It hasn't gone anywhere for a while, and do you see it lagging for the next little while, or is it just dead money? Thank you. I'll hang up and listen.
Thanks.
Well, as I said earlier in the program, software companies are really under the gun right now. Like, they could be going the way of the buggy whip. Enghouse falls into that category, as do a number of software companies worldwide. A lot of them are down anywhere from 20 to 50%. So we sold our Enghouse position a couple of months ago, as well as Dassault Systems. So our feeling is that software has been overtaken by AI, and it's going to be a challenge for them to be able to grow their businesses moving forward.
So not attracting you, and that stock this week hitting its lowest in at least a year. Keith, thanks for that question. Elliot in Hamilton, Ontario, fire ahead, please.
Good afternoon, gentlemen. Banco Santander has doubled in the last 2 or 3 years very nicely. Would you consider it to be in the second or the 8th inning of its growth plan? And would you start a position here around $10? Thank you.
Thanks.
The Spanish economy has been good. Tourism is up. In the EU, interest rates have fallen, and that's been good for Santander and also for Banco Bilbao, because they've pretty much jumped close to that 100% range this year. Challenges moving forward are going to be where is expansion going to come from? And then the big risk is what happens if the Spanish economy starts to struggle. If you've done well on this stock, you may consider wanting to pare back on your position, because usually if you double your money, it's usually a good time to sell half and then the rest is free. The storm clouds aren't out there yet. Everything's just kind of been working as expected. But when you get a stock that's moving that quickly over a short period of time, then chances are it's probably going to go sideways or down a little bit. So there's nothing wrong with taking some profits off the table. And if you own it, then congratulations, you've done well.
Okay, thank you very much indeed. We have an email from Monique. Monique is saying, I'd appreciate your comments on Fiserv after that drop in the stock. Is it worth holding on to?
Well, the problem that Fiserv have is that they've got competition now. They used to control the market with payments, and now there are all kinds of other players out there, and that's what really caused the fall off in the stock. Really, it comes down to what's the next phase of their growth business going to be, and that's where the investor has to really pay attention to it. And as a result, it also brought down a lot of the other financial services companies. And right now, it's just not a place to be, only because there's always that threat of competition moving forward. And it's important for the investors to be able to look and see what's the impact that competition is going to have, what's Fiserv going to do to ward off or create that moat. And that's the biggest challenge to all of these companies in that sector right now.
Okay, we are going to take a break. We'll check out David's past picks when we return. David was on our show May 14th of this year. His first idea was Alfa Laval, which is a big maker of industrial equipment for stuff like fluid handling. Let's see how that stock did. Pretty flat over the period, up around 4%. David, would you buy this one again?
I'm buying it right now, actually, Andy. It's a very good company. They're an industrial maker of heat pumps, but they also are in the marine business with trying to find ecological ways to be less pollutant for all of these tankers that are out there in the world. Mm-hmm. Company's been solid. Dividend growth has been good. You've also had the tailwind of the Swedish krona this year because it's been the best performing currency out there in the world this year among the majors. And it's trading at future PE multiples of around 10 to 15 times. So that makes it very attractive at this level.
Oh, okay. So you'd go on picking it up, and you are. Comfort Systems, Comfort Systems, FIX in New York, just, a nice one, up more than 80%. Remind us what this company does, Comfort Systems.
Yeah, it's an American company that makes HVAC systems, and that's why the stock's up as much as it was. It breached 1,000 before the sell-off began, mm-hmm. And it's really part of that infrastructure play out of AI in the data centers. But if you think of American consumers, their electricity bills have risen almost, I think the number was 274%. So that may force them in the future to get off the grid by, putting solar panels on roofs, or with the global warming that's going on in the southeast or the southwest of the United States. There's a lot of demand going on right now in buildings, in houses, and in the data centers for the HVAC systems. Mm-hmm. To me, seeing the stock go up 80 to 100% in the last 6 months just gives you an idea of where the momentum is coming from and the hype that's behind it. I do like the company. I'll still continue to buy it at these prices because they're growing their profits in that 35 to 50% range. But it does have a lot of volatility, even as I said, as a top pick 6 months ago. They have to watch this and pay attention to it because it doesn't move by $1 a day.
Okay, and then your next idea is Intertek, and they're a British-based company, and they're huge in testing and assurance around the world.
That's right. So you can't import or export any goods without government permission, and they're one of the ones that do all the testing. It's a small cap stock, so their biggest competitor might be SGS. But this company has more potential to grow their business than their competition. The dividend yield is good. The dividend's been growing at a hefty rate, and business has been good right now because, again, with all these tariffs going on, it just puts more importance behind what's being shipped out and being imported in. So it's a buy right now, too.
Would it not be vulnerable if there is a big turndown in world trade, or do you think that we know the worst of the tariff news?
Yeah, they can suffer in the short term, but business has actually been very good in the last 6 months. So the tariffs haven't really had an impact on their business yet, and they're not anticipating that it's going to continue that way. You also have to remember that on a percentage of revenues, Intertek doesn't have a huge revenue base going into the United States. So they're kind of insulated from what's going on in the rest of the world relative to U.S. tariffs.
Okay. Good stuff, David. It's great to have you here. David Driscoll of Liberty International Investment Management is taking your questions on global stocks. We'll be right back. Bob is on the line from Toronto. Go ahead, Bob, please.
Yeah, hi, Andy. Thanks for taking my call. David, I seem to be confounded with Microsoft. We have all the other Googles and IBMs and NVIDIA all going up, and Microsoft is going down. Any explanation for it?
Well, Microsoft isn't the only one going down right now because Meta has been falling off its high perch. And really, it's just a readjustment of what's going on in current news. So you've got all of these quant investors that are chasing after the latest news. So while Google is going higher, some of the other ones are going lower. If you think about year to date, Google is up 52%, NVIDIA is up 34%, but down 11% in the month of November. Microsoft is up 13 year to date, but down 7 this month. Apple's up 6, Meta's up 0.6, Amazon's down 1 for the year, Tesla's down 2. So the Mag 7 are only keeping base performance numbers with the S&P, despite the fact that they dominate the index. In Microsoft's case, Azure has been doing very well. Their revenue growth is better than AWS at Amazon and with Google as well. And that is a situation that shouldn't change anytime soon. So I wouldn't be thinking that Microsoft is going to disappear off the face of the earth. I think that these are very volatile stocks that you have to understand that they're not just going up or down 1% a day or a month. Mm-hmm. Their volatility is almost double the market. And after Microsoft's earnings came out, the street was satisfied with it, but not satisfied that they were growing as fast enough as expectations. So the stock's fallen in the month of November, but we own it for all of our clients, and I continue to buy more of it simply because they will be involved in what's going on with AI and the potential for quantum computing moving forward. It's important to have at least one of them in case it does come to fruition. Hmm.
At least one of the hyperscalers. And sorry, David, just touch, which is the hyperscaler you'd own if you were pressed?
Well, hyperscaler, it is Amazon, Google, and Microsoft is the one that we own.
Microsoft is, okay, just to clarify.
If I can just have a few seconds, Andy. If you think of a grid, you have the AI and the hyperscalers at the top because they're going to lead everything moving forward with the fast computation. The next level would be the chips. The third level would be infrastructure, like the comfort systems or Toromont or Stantec. The utilities would fall under that because, again, you're going to need energy to be able to run these data centers. You're going to have the financials doing the funding, the resource companies that if the US dollar falls and you have to go to something like nuclear power or more, they should do well because you might be in the beginning of a bull market for resource companies if the US cuts rates and the US dollar falls. And then you want to have the serial acquirers, companies, small cap companies that are out there making acquisitions where AI can't impact their future. And these companies are making widgets. So they're growing their business by 2.5% a year annually, and then making acquisitions in that 2 to 3% range. So now you're getting 4, 5, 6% revenue growth when global economic growth is in that 1.5 to 2.5% range. And they're buying small companies at a much cheaper price than you would if you had to buy a publicly listed one, because these are all the ma and pa's that have started a business, run it for 40 years. Now they're ready to retire and monetize their retirement by selling their businesses. So if you think of a big grid, this is really the tone and the structure of where investors need to look at their portfolios to have at least one company in these 7 different categories.
Okay, we have Chad on the line from Saskatoon. Go ahead, Chad, please.
Good afternoon, gentlemen. Could I have David's opinion on Cargojet, please? About 10 days ago, there was some insider buying, so I was just wondering if he'd buy at this level, or does he hold it in his portfolio? Thank you. I'll hang up and listen.
Thank you.
Yeah, well, Cargojet, just like TFI, anybody in the trucking or transportation sector is struggling right now because of tariffs, and volumes have fallen. So if you think at some point that tariffs are going to recede, or a deal gets done between Canada, US, or NAFTA, USMAC or whatever, USMCA, this could be a wonderful opportunity to pick up either or both companies, depending on how it fits in your portfolio. It's just right now, headwinds are coming to these companies, and investors are selling off, and it's also tax loss selling season. So this could be a decent opportunity to pick up a company like this.
Okay, yeah, but certainly Cargojet certainly has come under pressure. We have Mary in Burlington, Ontario. Mary, go ahead, please.
Hi, Andy. Hi, David. Nice to see you both.
Great, thanks.
David, I'm wondering if you are still holding on to your Lindsay Corp, and if you are, how come you still like it? And if you're not, what did you sell, or what did you buy, when you sold it? Thanks so much. I'll hang up and listen. Have a great day.
And Lindsay, a big player in irrigation and infrastructure, David?
Yeah, the irrigation equipment they make, they're using satellite technology to be able to map the fields and move the irrigation equipment around, which is a positive. The negative is the infrastructure side, because it's all road construction. Think of all those plastic barriers that reduce lanes over time. The construction business has been weakening, again, because demand has not been there. Spending in the United States has been not coming down through the states into that kind of infrastructure building. On the irrigation side, they did okay in the US, but struggled in Brazil. So a lot of these companies that have been under pressure, we did some rebalancing in the summertime, and Lindsay was one of the ones that I wanted to sell, only because it's just not doing what it's supposed to be doing. And after, the last 6 months since we sold it, it's just come under continued pressure and falling. What have we bought in the meantime? I haven't done anything yet. I'm still sitting on the cash waiting for opportunities to arise. But Comfort Systems would have been one of the ones that would have replaced the Lindsay sale.
And David, can you give us a ballpark idea how much of your portfolio or your model portfolio is in cash right now?
Probably around 10 or 15%. Every month, there's always a company that will perform better in 1 month than the other 11. So we've got the trades ready. It's just that we're in the middle of a semi-correction right now. So we may pull the trigger to refill the portfolios with either new names or more shares of what we own.
Okay. We have Colin, one of our regulars as well, in Sarnia, Ontario. Go ahead, Colin, please.
Yeah, hello. Thanks for taking my question. Emera, it's in your, third tier there. I'd like to know your opinion. I've held it for years. I'm getting a hefty 7+% dividend.
Wow.
But I'm just wondering what your opinion of it is at this time and for the future. Thank you so much.
Thanks.
Okay, we own Emera in our tax-free savings accounts. They are electricity producers on the Maritimes, but also down in Tampa, Florida. So again, you're getting this theme of needing to provide electricity, and rate base growth is always going to be the predeterminant as to where these stock prices go. So one, you're getting lower interest rates, which helps them. Number two, are they growing their customer base with new products? And with Emera, the answer is yes. And as you get new customers, then your rate base is going to grow, which means your profits are going to jump and your dividends are going to grow as well. So I believe the company has stated that dividend growth is probably going to be in that 3 to 6% range over the next few years as their projects reach completion. And then the challenge is going to be, okay, where else can we grow our business? What other areas can we either acquire or start to build out depending on what's happening? If you think of in the United States, a lot of the Americans are moving to the southern states just to avoid the winter heating season, and of course that growth in population down in those states. Who knows what Emera's next step might be? They may just continue to build on their infrastructure in Florida and continue to build out their rate base. So for us, it's still a buy. They're in the right space at the right time, and demand for electricity appears that it's going to rise. So they're right there.
Okay. Yeah, that's interesting about Emera as a play on changes in U.S. population. David Driscoll is taking your questions on global stocks. 1-855-326-6266. Charlie is calling from Montreal. Go ahead, Charlie.
Yes, hi. Thank you for taking my call.
Pleasure.
I'm calling about Novo Nordisk. It was recommended in the past as a great compounder, but now I'm down 25%, and I'm wondering, should I hold or should I just get rid of it? It's in my tax-free savings, which is why I'm hesitating to sell it. It won't help me with my taxes. Thank you.
Thanks very much.
Okay. This stock's probably from its peak around 1,100 Danish kroner is trading around 380, 390, so it's down about 55%. Challenges and headwinds. So you've got tariffs, you've got FDA, you've got pricing issues where they're having to cut prices to get access to Medicaid, Medicare in the US, competition with not only Eli Lilly, but also from other companies as their compounds come off patent. So you can see that it's just been a combination of factors. The CEO got let go. They didn't fill out the paperwork to get their patent protection in Canada, and the generics took over there. So this has really been a dreadful year for the company. It's now trading at a level that is, half decent. I wouldn't be buying more right now. And I'd just be sitting there on the impression that the weight loss business still has room to grow. It's just going to be a question of whether or what percentage or participation is Novo going to have in this. So it's still a decent company. It just got caught in the hype of weight loss. And again, as their results began to come out with competition, they've lost their pricing power. And as a result, the stock is down. And investors just have to be wary because the headwinds could last for all of the pharmaceuticals right now. Because even in general, if you think of a pharmaceutical firm, phase 1, 2, and 3 can take 2 to 5 years each. And now you have somebody heading the FDA who doesn't like vaccines, which is usually the first product that comes to market before the pill. So this is, lots of challenges out there for all of the pharmaceutical firms right now. And whether they can have pricing power moving forward is going to dictate what direction the stock price is going to go.
Okay. So you wouldn't be inclined then to go into Novo?
It's pretty much right now dead money. So for the viewer, if he has patience, he can hang on to it. But I don't think there's enough headwinds diminishing or tailwinds beginning to step back into the name at this time.
Okay. Gulam in Toronto. Go ahead, Gulam, please.
My call. My question is on ZQQ and SOXX. I hold both of them. They're all in the NASDAQ technology area. I'm just wondering whether you see much upside considering what's going on with NVIDIA and other microchip stocks. Should I continue holding them for further upside, or is it time to take a profit? I'd appreciate your comments. Thank you.
Thanks.
Well, we've had the big run up from the chips and the AI, so I don't know what your position is, your percent weighting. Our rule has always been if we have 30 stocks in the portfolio with an equal weighting of 3% each, that if one gets to 6%, we automatically sell half. And usually that enhances returns by 1% to 2%, compounded over a 10 to 20 year time horizon, because taking money off the table has never been a death knell. The other thing is that if we ever get a larger correction because they can't substantiate the growth that they've had, then here we are talking about the dot-com bubble when tech stocks went down 70%. If you have $1 and drop 70%, then you're at 30 cents. And in the dot-com bubble situation, it took 17 years for NASDAQ to get back to break even. So be cautious. They're very volatile. With the ZQQ, I don't understand the hedging situation, because all the ETF is doing is paying the banks to buy options or forwards to hedge the currency, when over time currency risk becomes benign. So, and then the other question I would have is, why do you have two different ETFs that do the same thing? Don't correlate your investments and diversify away from your QQQs with something else. Otherwise, you're going to have that volatility of up, down, and all around every day, every week, every month, every year.
Okay. Well, we can squeeze in one more caller. Mark in Manitoulin Island in Ontario, beautiful part of the world. Go ahead, please. I don't think I'm hearing Mark. Meta, David, your thoughts there, please.
Well, I'm not a fan of Meta. I don't believe that the ethics at the firm are very good. I'm not a big fan of Mark Zuckerberg. A way around the Meta investment is that we own EssilorLuxottica, which is making the virtual reality glasses for Meta. So you get less volatility. Essilor is the lens side, Luxottica is the frame side. And that's where we've owned that stock for a long, long time. And this year it's up around 48 or 49%. So it's actually outperforming Meta. So here's just another example where you don't have to be in those names. You can have companies to diversify your portfolio that have access to what's happening with AI and virtual reality, but you don't have to have all of the Magnificent Seven in your portfolio and take on that kind of volatility risk.
Okay, we are going to have to leave it there, but don't go away. David will be sharing his top picks next. Join us Monday on Market Call. Our guest is Paul Harris, partner and portfolio manager at Harris Douglas Asset Management. And Paul will be taking your questions on North American and global stocks. Oh, don't forget our daily podcast. Market Calls podcast is available on iHeartRadio and everywhere you get your podcasts. Okay, let's get to those top picks. The first idea here, Cameco, the uranium giant.
Yeah, this is a two-pronged idea that, number one, they own Westinghouse or a portion of Westinghouse. So if there in reality is going to be more growth and new building of nuclear power plants, then Cameco is going to be involved. They also provide the uranium. But investors have to think of this as a slow growth story. So we're getting volatility in the stock price right now. We're hit a peak over 150 and it's trading at 111. The second thing is, if the White House politicizes the Federal Reserve and forces interest rates down to 1%, the US dollar will probably fall, and that's going to send up commodity prices because all commodities are priced in US dollars. So right now you're looking at 3.75% to 4% of interest rates. If they were to drop 1%, you could easily see the US dollar drop 10, and that could start the beginning of a bull market for commodities. And that would put Cameco, the golds, the oil and gases right in that the wheelhouse for the future. But it could also cause inflation. So I think the US has to tread slowly. But in the long run, I think Cameco is a decent buy at this level, but it's going to have to be for patient investors only.
Okay. Your next idea, we're actually having a bit of trouble with the chart. Sorry about that. It's HDFC Bank. Just remind us what they are, David.
Yeah, they're the largest private sector bank in India. And unlike the aging populations of North America, Europe, Japan, China, the average age in India is 30. So there's a lot of growth going forward. If the Indian government is really focused on building out infrastructure, which is what their biggest issue is right now, then you want to own one of the banks in India to take advantage of that. So last expected earnings growth was 15% in the last quarter. Moving forward, it's expected to be in the 15 to 20% range. And that kind of earnings growth you're not really seeing among the Canadian and US banks. So this gives us good diversification around the world. And we want to be away from North America, just given the tariffs and better opportunities outside in international markets, essentially because the best performing major index out there is the emerging market index. It's up 28%.
Okay. And then finally, Lifco, AB. Remind us what they are, please.
Yeah. So here's an example of one of the serial acquirers that I talked about previously. They're a Swedish company that makes equipment, manufacturing, contract manufacturing, vehicle interiors, environmental technology. It's still an idea of where you want to start with a small cap that nobody's ever heard of before. And through their acquisitions, plus their organic growth, they can have a return on invested capital north of 15%, continue to grow the dividends at roughly a 15 to 20% level, and just sit back and let them just acquire over time and grow. And they usually are making their acquisitions without debt. It's using free cash flow. So this is a perfect example of one of the new companies that we're adding to our portfolios in the serial acquire situation that are outside of North America.
So what business? They're in the auto parts area, are they, David?
No, they make sawmill equipment. They basically make machinery and tools. Mm-hmm. So all of the little, dies and casts and even the heavy equipment that they make, they wouldn't be the big haulers, but they might make the little backhoes just for the smaller design. So it's something that AI can't really touch because they actually make something. And it's just a matter of having a smattering of all these different types of companies that are very well run, that when they bring them into the bigger company, into the mothership, that they're able to take that growth and be able to compound on top of it.
So you're looking for companies. You said you were reluctant to invest in many software companies right now. You are looking for AI-proof businesses?
Oh, you bet. Because that's one of the biggest fears right now, is that every cycle you're going to see something that falls by the wayside that can't compete anymore because of the new technology that's come to the fore. That's why I thought talking about the grid previously was a perfect example of some of the things that people have to think about as they either build or readjust their portfolios as to what's happening right now.
Any other areas that you think will be relatively immune to AI?
Well, it's going to be anybody who makes, so the manufacturers should be okay. Mm-hmm. The biggest issues that I've seen has been in healthcare, software, and consumer products. It's not necessarily AI doing it, but there are other trends that are going on. If you think of a Pepsi, people who are taking the weight loss drugs or going to no carbs or stopping eating ultra-processed foods. And as a result, the Doritos, the Cheetos, the Lay's potato chips, the soft drinks are starting to ebb as well. So I'd be very leery of owning consumer products companies right now.
I mean,
and as a result, their performances have been dismal.
Right. So maybe you can put up a 5-year chart for Pepsi, PEP. It's interesting. They are frantically trying to come out with processed food they say will be GLP-1 friendly, but it is going to be a challenge.
Yes, and according to the FDA and Mr. Kennedy, getting rid of all the red dyes and everything too is also another pressure point. And at the same time, they're coming out with, the miniature inflation, where the package sizes are smaller,
shrinkflation,
but the prices are the same. Yeah, shrinkflation.
Yeah, David.
And that's. Sorry, go ahead, Andy.
David, I think we're out of time. I'm really sorry. Okay. Thanks very much, David Driscoll. Thanks very much indeed for watching Market Call. Have a wonderful weekend.